Well, good afternoon, everybody. My name is Rich Harvey, CEO of Propertybuyer, and today we are having a fantastic webinar about how to buy a luxury holiday home at a fraction of the price. And I'm joined by Ryan Fritsch, CEO of Co-Homes. Welcome, Ryan.
Thanks, Rich. Appreciate the time.
And we also have Michael and Anna from Commonwealth Bank who will be joining us later to talk about some of the lending options that are available. So before we get started, just if you have any particular questions that you'd like to ask throughout the webinar, please just jot your Q&A in the Q&A box at the bottom of the screen. We will be recording this webinar and sending out a copy of it to everyone who's registered today. And if you've got any questions, we will be having a fair bit of time, 15-20 minutes at the end of the webinar, where you can log on and just send in your questions. But as one of us are talking, please just jot in your questions, and we'd love to get to it wherever we can. So let's get started. So thank you again for joining us. We've got a fair bit to get through. Hopefully it's very practical and very engaging, and you find it of interest. So what we'll be covering today is talking about some of the issues of high-end holiday homes and luxury holiday homes. We'll be talking about some of the pros and cons. And me being an economist, I'm quite analytical. We'll be looking at the pros and the upside and the downside, how this particular co-model came about and how it works in Australia, some of the top locations on where it does work, and also the sort of criteria where these homes can be fractionalized. So that's a quick summary of what we'll be looking at. So firstly, Ryan, I'm going to throw to you in a second, but I want to ask you, where did this co-concept come from and how does it work? So if you could, I'll just unshare my screen and I'll let you share your slides, then I'll pick up after you come in, please.
Yeah, absolutely. And I'll share my slides here just in a second, but just to give a quick overview, the whole idea is the fact that properties are underutilized in the holiday home space. So we're trying to improve the experience for holiday home owners. And we do that through co-ownership. So having up to 8 individuals co-invest in a property, but of course they're the owners of the real estate and get the benefits of that, but also get to use it, and we're the managers of that property, so they can just show up, enjoy the property, and leave. We do the rest. But I'll pull up my screen, do a quick introduction for everybody. And as Rich mentioned, Ryan Fritsch, co-founder and CEO. We'll do a walkthrough of just generally what co is, what we offer. Then, as Rich mentioned, we'll jump back and get a little bit more into the technical side, wrap up with CBA, and then some Q&A. Only favor I ask is for everything financing related and specific individuals, things that CBA will touch. That can be a follow-on discussion because each one of those scenarios is a bit different for each person. If everybody can see my screen.
Yep, all good.
Oh,
it's gone to the end. Gone to the end slide.
There we go.
Start at the beginning, I think.
Yep, there we go. Let's try that again. Cool. So once again, thanks everybody for the time. We're going to be discussing the first co-ownership platform here in Australia, but I'll touch on why this is the first, but we're definitely not the first globally. But before we get into that, I want to just talk about holiday homes specifically. So holiday homes are a lot different than your primary residence. It's different than a traditional investment property for a variety of reasons. And really, if you boil it down, it's more than a home, it's also an experience. You know, if you think of, and if any of you grew up with a family holiday home, probably have quite a few really good memories, really great experiences that you had with your family and loved ones. If you happen to own one or several nowadays, you can say that there's a lot of really great things about having that home away from home that you can jet off to. I myself have been a holiday homeowner for about 10 years. As you can probably tell by my accent, I'm originally from the US, have a property in Florida that I kept whenever I left a long time ago, is somewhere that I can call home when I go back to the States. That sounds all really good on paper. And if you think about all the memories that you can make, it is a great investment to have, and it is an investment. It is real estate. You know, if you look at historicals, there are a lot of upsides to owning real estate. But this is a bit of a different one because you're dealing with a property that, unless you rent it out, it's closed with the lights off and the doors locked most of the time. Or if you're doing short-term rentals, there's quite a bit of management behind that. So holiday homes are great, but there's a problem with them. They're costly to buy. They're costly to maintain, And they're just generally quite complicated to be the manager of. I'll give you a very practical example for me, just myself. Because I have a property still in the US, I was up at 4 a.m. this morning on a phone call with my property manager, because I do short-term renters for my property, since I'm only there a couple weeks a year at best. And we are dealing with just some general questions that they had on some renovations that I'm doing. That's not ideal, and that happens way more than what most people like to admit. Practically speaking, a holiday home's really only used about a quarter or less of the time, and that's being quite optimistic. You talk to most people who own a holiday home, it's really only a couple weeks a year that they actually go there. So saying 20% of the time or so is them probably being a bit optimistic on what their actual usage is. So the other 80% of the time, it's you're paying the bills, you're dealing with the issues. If a pipe bursts, there's probably no one there that will even notice it. And these are all just issues that you, as the owner, have to deal with, or at best, are managing a manager to deal with this, and you have the costs involved with all of that. I started looking at this space myself because a company popped up in the US called Picasso about 2.5 years ago of co-ownership of properties. So they manage it, you split the costs, and you don't really have to do anything. You show up, enjoy the property, and leave. And it got me thinking about my own home. Why do I own 100% something that I only use a fraction of the time? So jumping into what we really are is a business that provides a seamless homeownership experience at a fraction of the cost. So if you think of the term a holiday home, anyone who owns a holiday home, they probably don't have much of a holiday in that home while they're there. They're dealing with the maintenance, the upkeep, and everything else. So our whole idea is putting more holiday in your holiday home. Now, this is not something that we just came up by ourselves. Like I just mentioned, I was inspired by the company Picasso in the US for my own property. But this is a global phenomenon that's taken off in about the last 2.5 years, where tech platforms with the correct operating and legal structures can take a property that they don't own, they don't have any attachment to, structure it in a way for the co-owners that makes sense for those individuals as the equity owners. And that's an important thing that I'll get into, is that the co-owners really are the equity owners of these properties. Co and all of these other platforms are merely service platforms, making sure that you have a great experience. But this took off in the US back in 2020, moved through Mexico and throughout North America, over into Europe as well. This is just a small snapshot of some of the other companies. There's more than a dozen players out there that have scaled in the last 3 years, but nobody has been doing this on this side of the world. So we looked at this space about a year ago and said, what would we need to do to make a really robust structure that is scalable across Australia and then key travel destinations for Australians? We'll get into kind of the subtle nuances of how we're structured, because we do operate under a financial services license. So we are licensed to be doing what we're doing. That's for a more technical discussion. But I just wanted to highlight that this is not new. This is just new to Australia. And if you go a layer past this and you think of similar asset classes, the co-ownership of expensive assets is also nothing new to Australia either. If any of you have heard of boat sharing or yacht syndication, depending on what you're talking about, it's a relatively similar model. You're taking an underutilized asset that otherwise that would just be sitting there on the jetty, splitting up the ownership so it gets sweat, quote unquote, more effectively, and it's a lower cost for the purchase and the maintenance. Now, to summarize what we do, and there's a lot behind what we do, but that's my problem, not your problem. From a customer perspective, there's really just 3 steps: buy, book your time, and then enjoy your time and enjoy your property. What you're actually buying when you're working with us is you're buying into a unit trust that owns the asset. So you are actually a unit holder in the unit trust, and the only thing in that unit trust is your property. You are the owner of that. That's why I mentioned you are the equity owner of that with up to 8 individuals. Now, it doesn't have to be 8 individuals. We divide properties up into 8 units. But if you said, by the way, I think I'll use this property a lot more than just the time allotted, which I'll get to in a moment, I want to own half the property. You totally can. The reality is you just buy 4 of the 8 units, and you get 4 times as much of the usage and equity ownership of that asset. From the booking side, the booking's quite simple. For every 8, you get 6 weeks of time throughout the year, 42 days. That's not a fixed calendar. You book your time in when you want to show up. Similar to what you would do with any kind of short-term renter concept, except it's your home. From there, you show up, enjoy the property, leave. We deal with the cleaning, the complexities and everything behind that, but also the larger complexities around a home. We're making sure that people are paying attention to the repairs that need to be made, that we're setting a budget for the property to make sure that things are getting repaired in a financially sound way, the tax, the finance, the compliance of that entity. We do all of that. We just pass that information to you. So our idea is that you actually have a better view of the performance of your home than you do on your own traditional primary residence. So buy, book, enjoy, quite simple concept. Amongst this, we can get into some of the calendar details when we go into Q&As. But really what I want to focus on is you get 6 weeks a year per 8. If you think you'll use it more, you can simply buy more of the property. And how this works, and it's an important thing that I highlight this, we as a business are not buying these properties and turning around and selling them to the incoming buyers. We actually operate as a marketplace between the existing owners of a property and the incoming buyers or the prospective buyers for that property. So if you own a holiday home today and you say, by the way, I know I only use this a couple months a year. Why do I own 100% of this thing? Similar to what I said about my property in the States. You can sell the portion that you think makes sense for you. If you know you use it 3 months a year, so you only use it a quarter of the time, sell 75% of the property. As the incoming owners, you can say, by the way, I'm busy, I have a lot going on with work. I know I can only use this property a couple weeks a year anyway. Then you can buy 1/8 of the property off of that existing owner. And we as co are structuring all of that on behalf of the existing owners as well as the incoming buyers. The point here is there'll be a lot of documentation that we manage, we structure. Like I said, we are a financial product and we're licensed to do so. We do all of the essentially the heavy lifting on behalf of the existing and incoming owners. You just have to make sure that you're meeting the requirements that you need, meet the criteria for our onboarding purposes, which we'll discuss here in a bit. And then from there, it's your property. We're just the service platform that's managing it, so you can enjoy it and we do the rest. And I want to hit something really dead on because this will probably come up in a Q&A if it didn't show up already. But we are very, very different than the alternatives that you have in this space. Whether you have an investment property that you do short-term rentals on that you just so happen to use, whether you own a property outright, you just keep the doors locked and no one ever shows up except when you're there, but you have to deal with the costs. And the obvious one as well, which is, well, what about timeshares? And I really want to focus on the fact that we're not a timeshare. We're actually not designed the way that timeshare operators are. The reason for this is quite simple. We are not the equity owners. We're not sitting there with a big building saying, by the way, for a certain amount of money, you get usage rights, and that's your time allotted. And here you have week number 5 in the calendar, whatever else they describe. It's the complete other way around. It's your asset. You use it as you see fit. We just manage it on your behalf. Practically what that means is, even more simply, is that we can be fired. If a group of owners wanted to show up and say, by the way, you're not doing your job, we're going to relieve you of your duties. Or if code disappeared off the face of the earth one day, you still own your property. That is a very, very big difference between a traditional timeshare structure. We actually have an independent trustee that sits over each and every property, completely separate from us. So in those strange, once in a million outlier cases, they're there on your behalf. So they would help transition from either a sale if everyone decided to sell the property in or bring in a new manager, whatever case that is, they're there operating on behalf of you that we've put there in your place to make sure that you have a fantastic ownership experience. So we have the benefits, you get some of the benefits of full ownership because you are the equity owner. You can buy a portion of a property, fast forward a couple of years. If you see an upside in the market and you think there's opportunities to sell, you can take advantage of that. You get the benefits of offsetting cash flows the way that you do with a short-term rental. But when you add all this up, there's really nothing like us in the market where you get the benefits and you're able to forego all of these consequences. So I know this is a bit of a crash course. I know we're not getting particularly technical, but if you only had 15, 20 minutes to jump on the webinar, I wanted just to highlight what we are from a customer's perspective, and then always happy to have follow-on chats with each and every one of you of really what we do and how we can support. So with that, I'll hand it back over to Rich, and we can go in a bit more of the details from there.
Great, thanks, Ryan. We'll just come back over to this one here. So Ryan, thanks for just giving the background to the concept and how it's working. So I'll just cover a couple of things, just talking about, again, just reiterating what has been the traditional problem of like luxury holiday homes is obviously the big ticket price to get into the market, and you've got significant equity tied up in that particular one property. You're not really diversifying your investment base, and obviously expensive maintenance and the traditional low level of usage. And a lot of people only visit their holiday homes a couple of times a year, if that. So it's a great concept. So what are the benefits and the costs of this concept? Well, firstly, the benefits are it's fractionalized, so it's a lower entry price. It's divided into those 8 units as you've described. Essentially it's a user pays models, and it really reduces a lot of the maintenance costs. And it also means your equity is not as concentrated in one particular asset. You get to use the asset when you want to, but you can then deploy that money into other holiday homes or other types of investments that you might want to pursue. I guess on the negative side, you don't have total control. You have some control according to the shares that you own, but you don't have full control. But it is managed by a reputable group. And you do have limited booking times. You get, as Ryan said, 6 weeks every 1/8 share. And there's a particular fair and equitable sharing system of how that works. So that's just something to consider when buying or entering into this sort of relationship. Now, some of the locations where we believe that this particular model is going to work really well is what we call the prime holiday destinations. And I won't go through all the list there, but you can obviously see the really sought after areas: Gold Coast, Byron Bay, Mornington Peninsula, WA, Margaret River, Hunter Valley, Central Coast, etc. There's some of the really beautiful areas around Australia where we think the most premium and prime holiday home destinations will be in most demand. And we're also seeing very, very significant capital growth, and we'll continue to see capital growth well into the future. Now, I guess, Ryan, jump in here if I miss anything, but the buying process. Do you want to take over this part, Ryan, and just give us a snapshot of the buying and potentially selling process, please?
Yep, absolutely. So from a buying perspective, it's largely aligned with what you'd expect with a normal sale, but there are some particularities to it that I'm happy to go over. So we obviously have properties on our website. We'll list properties on kind of traditional real estate listing platforms as well. If you see a property that you like, it's pretty simple. Either reaching out to the agent that we're working with or reaching out to us directly. We talk about that property, the benefits of that property, and then of course, the product that we are and what we provide. But let's say someone finds a property they like the concept, and they want to proceed forward. This is an important piece, we're a wholesale AFSL licensed business. So what that means is we can only market to and only sell to accredited investors. So happy to go over the kind of the nuances of an accredited investor criteria as well. But in a nutshell, you need to be making more than $250,000 a year is one of the key points here. There's some subtle nuances that circumvent all of that as well in terms of net worth, but that doesn't stop anyone from having the conversation. If you see a property, you're interested, we can then start to unpack, what's your net worth? How much money do you make a year? Yes, you actually meet the accredited investor criteria, and then we can proceed with the actual onboarding side. So another important thing is we are a financial product. So we do have to onboard people in a very compliant way. So not to get too kind of banker jargony for our CBA folks here, but we do have to onboard people through a KYC, or know your customer, and anti-money laundering portal that is completely digitalized. So assuming you're a relatively normal human being with no strange outliers, you fill in the details of who you are, your bank account details, and everything else. It gives you a green light and says, great, everything's good. If there was some strange scenarios, let's say you're investing through a company, we might ask a couple more details about that company, but it helps automate the process to be as simple as possible. We require an upfront deposit just to make sure that you are essentially legitimate, and then would want to see some sort of proof of funds, or what the process would be for you to secure those funds to make sure the purchase takes place. Now, an important thing is this is where we switch, and this is almost in a similar way, kind of like how an off-plan development works. You're putting a deposit in to then make a purchase. But from here, there take a couple more steps that executes the sale itself. So of course, you're going to have to put in the remaining proceeds before the property transfers or before the property closes. But the key thing here is you're one of the buyers that's coming in to then buy the asset. So when you're coming in and talking about the property, we're telling you where we are in terms of that sale. So let's say we have an owner that wants to sell half of the property, and they're happy to commence the sale once they get two buyers, or a quarter of the property out of the way. If you're that second buyer that's coming in, that then strikes the legal process, and the home is yours quite quickly. If you're the first buyer, we would let you know, by the way, you're number one, we require two. And then from there, we would take a deposit, and we would keep you in the loop as the sale process commences. So it does take a couple steps, because we're pooling funds from the co-owners to then commence the real estate transaction, which is obviously a little bit different than a traditional real estate sale. It's more like almost how development works in a lot of ways. From the sale side, if you want to jump to the next slide.
Yeah.
We aren't an open source marketplace for owners, just so people know. I get realistically 2 to 3 owners a day that reach out to me and say, hey, by the way, I'm interested in fractionalizing my property. And that's fantastic, and I want people to do that. But ultimately, we decide what properties we market based on their location, price points, build quality, if it needs a renovation, and so on and so forth. But let's say we find a property, either working, essentially sourcing the property, working with Propertybuyer and other groups to find properties out in the market, or an owner actually reaches out to us and says, hey, by the way, I like the concept, can we commence? We would then do an initial DD process just to make sure, like, hey, what that really means is I'm going to the property, or someone from the team most often, talking with the owner, talking about their intentions, and then we would start marketing the property. Marketing the property doesn't change anything legally. So what we're not doing, and it goes back to my previous point on the buy side, we're not changing some legal structure the moment we start working with someone and then selling units of a trust for a co-ownership model. We are marketing the property to the outside world to see if we can pool the funds together for individuals to then become the co-owners once we meet that criteria that the existing owner is looking for. And I say this because we're working for the owner to make sure we get what they're looking for from the collection of funds from the incoming buyers. That's an important thing to know, because as an owner, assuming you have a property that meets our criterias, we're not doing anything legally. There's no risk for us to be able to market your property and think, oh no, now there's some weird legal change. That's not the case. It's merely a listing, no different than almost a traditional real estate listing. Once we get to that point where we've achieved the price or the number of units sold that the owner is looking for, the property is then transferred into the unit trust that we are the managers of, and the units of that trust are immediately sold. Now, if you think back a slide, we've already secured the funds for that trust. So all that's happening is we're transferring the property into our trust. Those funds that are sitting in trust are then there for the units that are being sold, and the existing owner gets the proceeds from that sale. At that point, we have a formal co-ownership structure, and we have a property that's in the co-ecosystem. Now, I know that's probably a bit technical. It's a little bit different than the average real estate kind of transaction. Behind this, there's about 150 pages of legal documentation that we did all the research to make sure this works. So I apologize that this is a bit technical. If you're looking at this from the other side and you say, this sounds like a lot, there better be a lot of detail behind how this actually works. We have that as well. I tried to keep it as brief as possible, but still give people a bit of confidence on how this process actually works.
Thanks, Ryan. That's great. I'll just pick up here on the types of property and what the features are that we're looking for. So just to explain too, Propertybuyer has been appointed exclusively by code to find the particular types of properties that fit their model. So not every holiday home will fit the model. We're looking for really nice quality and luxury holiday homes, typically from $3 or $4 million up to around say $14-15 million is the ideal range. So we want particularly freestanding luxury homes. They will look at apartments potentially if they're really nice penthouse apartments with great views, but ideally houses where you can consider maybe 1 or 2 families staying in the property at the same time and just creating a great family experience or a great holiday experience. So extra bedrooms are certainly looked after, extra living spaces are very much looked after, certainly well-appointed features. That's sort of the key. So in terms of the individual features, something that's unique, something that really stands out, that spells the wow factor. Ideally, it's got a waterfront or a country vista. It's got extensive entertaining areas. You can imagine sitting around a fire pit or around the pool, just relaxing, having a great time. That's the sort of thing that we're looking for in the co-ecosystem. Certainly got to be high quality. We don't want properties that are going to be a nightmare to maintain and are going to be needed to be repainted every 2 years. And ideally something that's turnkey. Each of the properties ideally would have a set of furniture in. If not, they'll need to be furnished. So it's just a move in and enjoy as a holiday home from day one. So particularly pools and outdoor areas, basketball court, tennis court, those sort of things are really great features that can add a lot of value to the whole holiday experience. So you kind of get a bit of a picture. And if you do go onto the Code platform after this webinar, you can have a look at the sort of properties that they've currently got. We're just going to do a little bit of a transition now. So I'm going to invite Michael and Anna to jump in here and just give us a bit of a background on how potentially you can finance a fractional ownership of a holiday home. So Michael and Anna, I'll hand over to you guys. Thanks.
Thanks, Rich. So thank you, Co-Homes and Propertybuyer, for this opportunity to present today. So my name's Anna Schertz and I am a Premier Banking Manager for the Commonwealth Bank. I've been with CBA for 15 years, half of that time in the leadership space. Here today I have Michael Kirk, who has been a Senior Relationship Manager for over 5 years, so a wealth of experience in the lending space. Given we have a very short time slot today of 5 minutes, we'll be presenting to you on what seems most relevant to the target audience, so which will be basically around releasing equity from your existing property. So if we can just go to the next slide, please, Rich. So there's always a disclaimer with the banks. So before we kick off, I do need to make you aware that today's session will cover only general information. So you'll need to determine if it is suitable for your individual situation. So yeah, I will now take it over to Michael to present.
Sure thing. Hi, everyone. Thanks, Anna, for the introduction. It's a pleasure to be here to present to you all today. As Anna's mentioned, we're primarily here to talk to you about how we can assist you with co-ownership, and this is primarily going to be by utilising equity in an existing property. I'm sure everyone's heard a phrase relating to equity at some point, whether it be utilising available equity in a property or potentially by another alias, cash out, and you may already have a very good understanding as to what equity actually is, but just to make sure we're on the same page, I'll quickly cover the basics. So from a bank point of view, equity is simply the difference between the market value of your property and the amount that you still owe on your home loan. So there's a couple important things to note around this is to be able to look at releasing equity, the banks actually need a security to lend against. So primarily you need to own a property before we can even consider this option. Secondly, another important thing to factor is that banks have LVR margins. LVR is another term you may not have heard before, and essentially stands for loan value ratio. This is basically how much of the property value is leveraged as debt. So the banks typically like to float around an LVR ratio of 80%. However, there are instances where we will entertain higher margins. Richard, we could just jump to the next slide. Thank you. So I just want to look at a couple of practical examples with you all, just to give you an idea as to how this would actually work. If we look at the left side of the page, you can see your lovely house there, assuming the market value of this place is around $1 million. And let's assume that you've got an existing debt of 500,000 on that place. So if we look at it from a non-banking point, your actual equity in the property would be 500,000. So 50%, the bank owns half and you have half. But if we then factor in the bank's typical lending margins and say work around 80%, that means the bank's willing to leverage up to 80% of debt against that property. So in this instance, if your property is worth $1 million, the bank's happy to say, we'll allow up to 800,000 of debt against that property. So when we look at it from a lending point of view, we have to consider any existing debt that's already on the property. So in this example, if you've got $500,000 owing already, and the bank's willing to allow an 80% lend on your $1 million value, that's 800,000. So the difference in that is 300,000. So essentially, that's what we would say your available equity in this position is. Now, what we would then look at doing when we talk about releasing is we can essentially do a new facility. So we do a new loan, or we do a top-up facility where we basically extend the credit available on your existing loan, and we give you that 300,000, which is essentially where the term cash out comes from. We utilize the equity in the property to then release cash to you. And then with that cash, you're able to go and pursue alternate investment options at your own will. Now, without going too much detail around the structure, it's important to note that when we do look at completing equity releases, we're able to also pair offset accounts to these facilities, which will offer a bit of flexibility and help reduce overall interest payable. If we look at a more complex scenario on the right side of the page, so say you've got an occupied residence and you've also got a couple of investment properties, and these are just your typical investment properties where you put a full-term tenant in there. So the principles are exactly the same. We look at what the values of the property are, and we look at what the existing debt is. So essentially, if we assume the combined value of all these three properties is $3,160,000, we then need to just assume that the lending principles will be the same. The bank wants to ideally take out an 80% lend at max. So if we assume that, the collective debt that the bank would be willing to leverage against these properties is looking to be around $2,528,000. Then if we look at the existing debt, assuming you've got those three loans there, 503, 592, and 499, that's a total existing collective debt balance of $1,594,000 that is currently leveraged against these properties. Again, in the same logic as the first example, we look at the difference between what the bank's acceptable security position, so 80% of the combined value, would be against the existing debt position. So the difference between the 80% value and where your current debt position stands is around $934,000. So in this instance, again, we'd be looking to establish a new facility and essentially give you that $934,000 to then go and pursue alternate investment opportunities or participate in the co-arrangement. If we could just go to the next slide, Rich.
Sure.
Thank you. As Ryan mentioned earlier, the capacity to which we're going to be able to assist is going to vary dramatically depending on your own financial situation. So if this is something you'd like to discuss further, or if you've got any further lending needs that I may be able to assist with, I would love to hear from you. My details are all on the screen at the moment, and given we're a bank that invests heavily on technology, I've actually got a QR code there which you're able to, whether you've got the time now, scan with your phone, or when the presentation comes out later, you can review it and scan it then. And essentially, if you just scan that quickly, it'll actually prompt you to save my details as a contact in your phone, just so you can easily reach out to me. But I'd just like to say thank you again for your time today. I look forward to anyone who does happen to reach out and discussing things further, and I'll hand back to Rich and Ryan. Thank you.
Great. Thank you so much, Michael and Anna. Appreciate those insights. And yeah, as I said to you guys before offline, I've just recently done a refi to get some equity to do exactly what you're talking about, and some more investing opportunities. So it's a worthwhile strategy. So look, we're going to open it up now for Q&A. So in the bottom of the screen there's a Q&A box, and if you get, I know a couple of people started typing their questions. I've got a couple more questions for Ryan too. Also, my details are there. And if you are interested in considering buying a fraction of a holiday home, then please reach out. Or if you've got a property you want to consider for the co-platform, please reach out to myself and be delighted to have a chat and go further with that. So Ryan, I'll just open it up now, take it off the screen share. We'll just pull up the Q&A. So the first question for you, Ryan, does the property get rented out when the owners aren't using the home? So let's say I'm an owner, I've got a 1/8 share, but I only want to use my home for 3 weeks. What can I do with the other 3 weeks?
Yeah, so we're deliberately vague online about this, but there's a reason for it. And it's because every property is a bit different, so the answer changes. So not to be vague, but the answer is it depends. Categorically, yes, we would rent out a property, assuming that it is a property that, let's say, there's no restrictions from a government or a regulatory perspective. There's no essentially community restrictions on it, or it's in a property, there is a situation where we look at the property and we say, by the way, just because of its price point, location, or whatever else, this is a beautiful home, but we just don't see it creating enough upside to justify the complexities in short-term rentals. So with that saying, most of the time, yes, there is that opportunity. However, there will be properties, and we'll be very explicit about this for those properties, saying, by the way, this property would not be able to be short-term rented. So just be aware of that you won't have that ability to do the cash outflow, to offset cash outflows. Now, with that being said, the way that we're designed, and I get a lot of questions about this, we are usage focused. So it is about being able to give people access to these high-end homes. While it is possible to offset cash flows, even make a yield with some properties, that is not what we focus on. We will never market a property and say, by the way, you're going to make this percentage of yield if you rent out all of your weeks or anything like that. That is not what we're designed to do. It's usage first, and then the financial cash out or cash flows being an interesting second if there is that opportunity there. It's still your real estate asset. Of course, you can sell the property down the road, make appreciation if there's that opportunity, but that short-term cash flow piece is not our key value proposition. The other side of this, though, it's a bit of a segue, but I didn't mention this earlier. If you're not going to use the property all of the time, we have a partnership with a company called Third Home. So what Third Home is a luxury holiday home marketplace to exchange time. So let's say you take a week of your 6 weeks, you put it in Third Home's ecosystem. From there, you could then stay a week in France, for example, or California, or wherever it is you want to go, because they have 15,000 properties around the world, all owned by luxury holiday homeowners such as yourself.
Okay. So I think the answer is simply it's flexible. It depends on the property. The goal is not a yield play. It's more a holiday ownership and usage play rather than getting cash flow. Another question, your second one, are you listed on the title of the property as in tenants in common? So
No, you're
my
not.
understanding is not, it's simply on the unit trust deed.
Yep. So part of what we believe, besides the research that we've done around tax effectiveness and operating effectiveness, onboarding and offboarding individuals, part of our concept is privacy. So we want people to not have to deal with the complexities of being on a deed, or even co-owners knowing each other. Each co-owner is completely private from the other co-owners as if it's your own home. So the answer is no, you are not on the title.
Okay. And do you have any properties coming up in WA soon?
That is on our roadmap, yes. So we have focused on the East Coast in the short term, but we will be looking, and we've had some articles about this. We're not just in Australia, so we're looking, of course, to the West Coast, but we're also looking to expand over in New Zealand in the near future. We have properties in Indonesia, in Japan, and we'll also be launching Thailand here quite soon.
To answer that question, yes, we do have 2 or 3 properties in some beautiful parts of WA. We're currently just talking to a couple of owners about how that might work. So watch this space is the answer in the next 2 months. Another question from Peter here is any part of the purchase of the property by the trust funded by debt?
No. So the way that it's structured right now is if you have a debt structure similar to what Anna and Michael just mentioned, that sits with you and your existing collateral outside of this. There is no debt that we as a business, nor could we even put debt on it because we're not an equity owner, or any of the existing co-owners have currently. We are in the process, my apologies that we're not presenting that today. We are in the process of offering a debt opportunity through a non-bank lender to provide leverage on the units of the trust. There's a key point here, and CBA touched on this. That has to be completely isolated and not impact any of the other co-owners in the instance of a delinquency and default. So we've been quite strict to make sure that in our discussions, when we structure that, if you're one of the other owners, there's no way, shape, or form you could be impacted, which is obviously quite complicated from a financial products perspective. So no, there's no debt on the trust. When that becomes an option that you can provide leverage directly on your units, still as the other co-owners, you'll not be impacted by that in any way, shape, or form.
So I guess that's a similar question. I'll just throw in one of my own questions, Ryan, is if someone does run into financial trouble and they have to sell their assets or they get divorced, what you're telling me is that the other unit holders will not be impacted adversely by the fortunes of one of the other current existing unit holders.
Exactly. So in our documentation that's quite lengthy, it describes essentially what happens in situations of divorces, deaths, if someone stops paying their bills, and what's the processes involved with that. If we have to, I guess in a nutshell, if we have to actually sell on behalf of the other owners to protect the other 7, if someone just stopped paying all their bills, we have the power to do that with the support of the independent trustee of that property.
Okay, great. Another question, why is it divided by 8 and not 10? Because 10 might get more people or make the fraction even lower.
Yeah. So, what the research, and this is a big kind of global research piece. Most people use their properties, like I said, less than 20% of the time. So it comes out to 5 or 6 weeks a year. So I'll start with the other end of the spectrum. Going into a quarter of the property for most properties just doesn't make a lot of sense because most people won't use them that often. If we go down to 12ths, operationally, that is actually quite complicated because you're dealing with 12 individuals rather than 8. So we've built everything around that idea that people are using their properties 5 to 6 weeks a year as a global average. Obviously, every country and every region is a bit different. The other side of this as well as essentially the standard with co-ownership models around the world right now is going down into 8ths. So rather than try to confuse people if they look at Picasso or anyone else, we followed the same trend.
Right. Okay. I guess another question, which is similar to this next question about, so there's no cash flow directly from the property, and what are the average expenses per year? Tell us about how the property is managed and how those expenses are shared across the ownership.
Yeah, that's a good way to describe it. So obviously with every property, you have things such as utilities, you have if there's a pool being cleaned, the lawn being mowed, all of that, you have those expenses. The benefit that you have in this instance is that they're divided into 8ths or whatever the ownership actually sits. So let's say, just simple math, it was $1,000 a month to maintain a property, then you're only paying $125 because that's your respective portion. The other side of this, though, is that the property is fully managed. So this obviously isn't for free. Cleanings and things like that of that nature are still your responsibility. So if you go for a week, enjoy your property and leave, cleaning company comes in, cleans that property, that's a fee that you're responsible for. We don't divide that up into even 8ths because someone might use the property 4 days at a time and someone else uses it for 2 weeks at a time. And that wouldn't be very equitable to charge someone who uses the property more frequently to get a smaller bill. So you of course have taxes, general maintenance. We do put a reserve fund aside as well. So if there are any breaks or the roof needs to get replaced or anything like that, we structure that into a full operating budget that the owners get visibility on for the year, and they're responsible for their respective 8. If there was a short-term rental component, we would use that to offset the cash flows as well.
Right. Now, tough question, Christmas. Everybody wants the Christmas week. How do you decide who gets Christmas and Easter?
Yep, so a couple things. I'll actually skip past that one first, but I'll talk about peak seasons more broadly. So peak season, we cut into your respective share. So let's say peak for wherever a property is roughly 16 weeks. If you own an 8th of the property, you get 2 weeks worth of that peak season. So yes, you have 6 weeks, but you can't use all 6 weeks in that peak period unless there was extra availability that just didn't get used. Now, the outlier of all of this, of course, is something like Christmas. Key point here, if you book that Christmas week, you are disqualified from using it the next year. You just simply can't use it. We've taken that approach rather than allocating essentially a Christmas year every 8 years, just because that seems a little bit too robotic. But taking the other end of the spectrum and saying, yep, first come, first serve for Christmas just seemed a little bit too loose.
Right. Now, if you want to sell your share, like you've owned it for a couple of years and your life circumstances change, you just, wanting to sell it, does that get offered to the other stakeholders first, other shareholders first, or not?
Yep. So the way that it works is the existing co-owners of that property. So not all of CO's co-owners, but just the co-owners of that property, they get first right of refusal. So you would let us know, hey, it's been 3 years. I love the property, but I want to go buy something else. So I'm going to sell this. That's totally up to you. We can help you with the price and everything else to bring it to market. But once we determine, yes, you want to sell at this price, we then offer that to the existing owners first. Globally, that's actually the first people that pick those up on average. So if I own an 8 and I see another 8 that comes on the market, I fall in love with the property. Yeah, I'll grab that and have a quarter of the property now. But let's say none of the owners buy it. Then if you had someone in mind that already wanted to buy the property, that's great. Congratulations. We don't have to support. So we don't have to take over the transaction. We just onboard that client. But if you say, hey, I just want to sell it, what we would do is then list it. We'd work with local real estate agents to then sell it quite similarly to a normal property.
Right. Okay. Now, how much power does Co have to make maintenance and painting decisions? Can Co go in there and paint the garage door pink and balustrades blue and decide what's what, or do you have to consult with the owners group first?
Yeah. So there's obviously a bit of a balance here where we want to make the property as stress-free as possible. So let's say a window gets broken, and no one was to blame. If something broke the window, we're going to get that repaired. Obviously, that comes out of a reserve fund, but we're not going to ask for permission to repair a window. Anything that changes from a design perspective, yes, that involves the owner. So let's say we're going to completely repaint the house, or it's time for new furniture or anything like that. We would essentially get quotes, get concepts, pass those to the owners, and then similar to almost like a strata process, we set a motion and then go from there. So we're not trying to make the decisions on the look and feel of the home. We just want to make sure when you get there, it feels like home.
Right. Now, if someone wants to buy more than a 1/8 share, how many 1/8 shares can you buy?
Up to 4. So we want to make sure that no one essentially can force everyone else into decisions going to that voting process that we just described. So yeah, you can buy up to half of the property with 4 units. And then of course, a very common question that I get asked is, well, can I go buy units in other properties? The answer is, of course. If you want to buy 4 1/8 across 4 different properties, congratulations, you have 4 holiday homes.
Right, excellent. And also another question, what is Co Homes making out of this particular venture?
Yeah. So, the benefit for us is as we scale our properties, these co-ownership properties are ours that we manage. And like I mentioned, theoretically, we could get relieved of our duties. But as long as we're doing a good job, we're the managers of these properties. So we do charge a platform fee per month per owner. It doesn't matter if you own an 1/8 or a half of a property. It's just a flat fee every month. We don't charge anything for the operating expenses. So going to my point of having the full budget for the property, we don't charge any premiums on that. So the light bill is the light bill. The landscaping is the landscaping. You're just paying your respective portion. So we charge a fee to structure everything initially for the fractionalization of a property into the co-ownership model. We then charge a platform fee per month. And then if you resell, we would charge similar to an agent commission to help support that as well.
Right. Okay. Someone's keen. Who's the best person to go in contact with? We'll be sending around a copy of the slides, but please just get in touch with myself and I'll make all the introductions. And whether you're looking to buy a fraction or to sell your property through the fractional program, I can help you facilitate that as well. Ryan, just to kind of give people more confidence, I guess, how much due diligence is done on the property before you put it on the platform? I mean, is it just a matter of, oh, that looks nice, a pretty picture, and you put it up? Or what goes into the background?
Yeah, and this is a key point where it's, we're not an open marketplace where someone can go and load pictures of their property and try to sell stuff. There's some platforms out there that essentially offer that. It's just a big open source marketplace, and you can buy and sell stuff. That's not what we will ever do. The sales process for the property is really where our job begins. We have to think about the fact that we will manage this property probably for forever, unless someone essentially writes a big check and buys the property outright from all of the owners, that all the owners don't want to be involved anymore. While individual owners may come and go, it will stay our property in perpetuity. So with that being said, we have to make sure initially it is a property that meets our expectations. It's part of the brief essentially that we do with Propertybuyer to make sure that everyone on the ground is looking for the things that we're looking for. On top of this, we go and look at the properties ourselves to make sure that the property is sound, that the owner expectations are aligned with ours, long before we ever even market the property. So before it's ever even shown. The layer beyond that is this is still a traditional real estate transaction. We're going to do title searches. We're going to do all of those things to make sure legally we can even do this before the transaction takes place. So it's quite a bit of a robust inspection beforehand. And then there's the added layer of a complete DD process to make sure that there's no title discrepancies, 5 years from now because someone dropped the ball.
Yep. No, I can tell you behind the scenes, I've been looking at all the properties. I vet them first before they go to Ryan's inbox. And my team is very, very thorough in what we look at. We've rejected quite a few. We've also accepted quite a few, and we'll continue to run that process. So it is just like when you expect a service of a buyer's advocate, we want to make sure the buyers are fully protected and get exactly what they're after in that process. So that's what we're after. Ryan, we've run out of questions there, but unless you've got anything else to add, I think we might wrap it up. Anything else you wanted to finish with?
No, I just want to say thanks everyone for the time. We're quite excited about bringing this to the market. We see this, particularly in Australia, as being a real value add given the prices of property here, as they keep, despite wild fluctuations. The reality is there's no more land getting added to continental Australia. So we see ourselves as being a genuine high quality opportunity for people not just looking to invest, but to have something for their family and friends for their future. So appreciate the time. If you have any questions, feel free to reach out. And like Rich mentioned, the video details and the slides will go out here after the call.
Right, fantastic. And look, I'll just finish by saying thank you, Michael and Anna, also for joining us to talk about the financing side of things through an equity release. A clever, smart strategy to actually access a holiday home at a 1/8 of the cost. Look, when I first looked at this process, it did take me a couple of hours, days, weeks to get across it. But as I've got into it more and more, I'm very much more in favour of it. And I've got a very economics analytical brain, and both from an emotional and an economic point, I can tell you it does stack up. So if you do have any interest, please reach out, and we'd love to engage with you further in the future. But I'll say thanks for now. We'll close off, and hope you enjoy the rest of your day. Bye for now.
Much.
Thank you.
Bye.
Bye.